I want to welcome everybody to today's presentation. Inflation and geopolitics will drive the next leg of gold bull with Chris Blasi. My name is William Mucker. I'm a client executive with Camaplan. And before we get started, I do have a brief disclosure to go over. Here at Camaplan, we're a neutral third-party administrator of IRAs. We're not attorneys, CPAs, or financial advisors. If you're looking for advice in any of those fields, we highly recommend that you consult with the necessary professional. If you have any questions that we can answer, feel free to bring your professionals in and we can get on a conference call and make sure that your IRA is being administered exactly how your professionals recommend. We also do not endorse or sell any products. We're, as I said, a neutral third-party administrator. So always do your due diligence before choosing to invest in anything out of your IRAs or even your personal funds. Here is my contact information. Again, William Mucker, a client executive. You can reach me at the number or my email address, wmucker@camaplan.com or info@camaplan.com. If you reach out to us today and decide that you would like to open up an account with us based off the information you learned today, just let us know and we'll waive the $50 application fee. Without further ado, I'm going to pass this over to Chris Blasi, who is a veteran of the financial and technology industries and is the creator of the patented PMC ounce. And as you can see here, you can read this over. There's no shortage of accolades or experience for Chris. And yeah, without further ado, I'd like to pass it over to Chris.
Thank you, Will. Thanks for joining today, everyone. I mean, we're in very exciting times, especially in the precious metals world. So I'm looking forward to sharing some of our observations with you. Let me share my screen so we can. Okay, I'm hoping everyone can see that. And let's just change the mode. Okay. All right, so again, as Will said, my name is Chris Blasi. I am the original founder, and I do head up as president of Neptune Global. For some of you who may not know us, we are headquartered in Wilmington, Delaware. That's actually where all the metals are stored from storage accounts. We were established in 2002, which was the exact start of the gold bull market. We are a full-service precious metals dealer. We deal in all the traditional bullion, bars, and coins. Plus, we have a number of proprietary or innovative and patented products that are true to being physical precious metals investments. So there's no compromise there, but they're actually more efficient and give a lot of advantages to the investor. And as Will said, we are the developer and the innovator of the gold and silver vault accounts and the PMC ounce, which means precious metals composite. We've been fortunate that we've been recognized and quoted and interviewed by a lot of or most of the mainstream financial publications. Some of the names are there, and that's not an exhaustive list. Happy to say, as I just said a minute ago, established in 2002. So we are just celebrated our 20th year. So, we're quite happy about that. It's been exciting to see. And I think it gives us a lot of credibility as far as our experience and all the ways the precious metals have traded through various and different markets, whether through the financial crisis of 2008, bull market and pullbacks. So this presentation is going to contain a lot of our opinion here. We just provide it to you for informational purposes only so that you can use it as you're doing your own due diligence and deciding what's best for you. As Will said, title of this, and it's no longer deniable, inflation. And inflation is probably the most insidious thing as far as impacting the lifestyle of investors. I mean, it is not a small matter anymore. It's been around for years, it's been denied, but now it is so obvious and so pervasive and so damaging that it is really starting to affect some people's lives. It starts sometimes outside of the United States in a more dramatic fashion. So I don't know if anyone's been following, but they're talking about how the standard of living in places like the UK are collapsing to levels or at speeds and with a ferocity that hasn't been since World War II. So this is important to all of us. I don't think anyone here will deny that it's happening in real time. You go to the food store, you go to the gas pump, you go anywhere. you buy supplies, you buy materials to build a home or fix a home. It is all over the place. So the question is, how did we get here? An important thing to remember. So when you're listening to voices out there, the voices in officialdom who told you there was no inflation or the policies of the government and the Federal Reserve wouldn't give you inflation, of course, were wrong. And they were wrong for a reason, not just incompetence. A lot of it is by design. But there are those, and I'm happy to say, including us here, that said what transpired over the 20 years, and we'll show that gold did quite well over those last 20 years, despite what the mainstream media says, but everything that was happening is now led us to where we are right now. This has nothing to do with the pandemic, right? The pandemic just added to an already broken system. So how did we get here? Basically, the United States transformed really in the early 80s to a total consumption economy that was all based on debt. Debt drives everything. It inflates assets. And I know a lot of folks with the self-directed IRA firms are in real estate, and real estate assets are driven by debt because people borrow to buy properties. And those with the experience know that whenever they loosen the standards, you get more borrowers who take more risk and will drive up prices like they did up through 2008. And then there's the inevitable pullback. So the economy, and it's not just real estate, right? Debt has been driving everything in this country. We shunned being producers, right? That we handed off predominantly to China, and we just continue to issue debt. It was the government and the powers that be told people it doesn't matter as long as you pay your debt in your own currency, it'll never come back to haunt us. But now it's happened. So we have, since the 1980s, the government has continued with the Fed enabling them, blowing serial bubbles. Those bubbles would pop and it'd be replaced by another bubble. So the most recent is in 2000, you had a stock bubble that popped, was followed by a housing bubble, right? We moved from the housing economy that popped in 2008 and 9. And then just we have what they call the everything bubble. So debt has been created to sustain consumption and create a lot of malinvestment. And that's what really drove a stock market, right? For those who are interested or active in the stock market, we know that, the PE ratios that are acceptable now were never acceptable 20 years ago. And not only low PEs, but companies with zero PEs, because people bid up stocks because they're meme stocks, predominantly tech stocks, even though they have no earnings and they don't even have earnings on the horizon. That would be a good example like Uber. Right? Their model showed that they would never become profitable, but people bid up the stock. That only works at a debt-based economy of pure speculation. Also, during these times, what do the powers that be have done? They've always bailed out the big players, right? The banks, the hedge funds, all to the detriment of the taxpayer and the people that the debt ultimately, who are ultimately responsible for all this debt. There's also been denying that there has been inflation, right? A couple of years ago, when interest rates are at zero because they said there's no inflation. In the real world, people knew, but everything is about managing people's perspectives. And we talk to investors, hundreds and hundreds of investors every week. When the mainstream media was telling people there was no inflation, even though in the heart of hearts people knew there was inflation, just look at the cost of college tuitions and such, they would feel, oh, well, there really isn't. Now it's so obvious, everyone sees it. Now having cash in the bank at zero is now people are getting scared and they're looking for places to put it. At the same time, the stock market has been contracting ever since the start of the year. Real estate is very high priced, right? And areas are shifting, right? There's super hot markets like Texas and Florida, and then there's places like Manhattan that are contracting, but you're buying in at a very high time, but you're also, with real estate, you're predominantly, obviously investors need tenants, and what the financial health of those tenants will be in the next several years is questionable, so that adds some risk. And we know with the pandemic, they allowed rent moratoriums. So they're just creating laws and weaponizing the financial system, which makes it very hard to invest. But this is why we're in the mess we're in right now. This constant adding to the debt has been to fend off deflation. The natural forces, if the market was allowed to be free market years ago, asset prices would have deflated, but that would have collapsed the economy. That's why there's this never-ending printing of money and issuing of more debt and propping up the system. But it can't go on forever, and it appears that we're in a precipice or in an inflection point. Interest rates have been artificially suppressed for a long time. And even when you hear about the Fed talking about raising the interest rates 0.75%, 0.5 to 0.75%, that is peanuts compared to what the real interest rate is. I mean, the officially declared interest rate is, inflation rate is over 8%. The real world is more like 15, 16. So a 0.75% rate hike is going to hardly do anything for investors in fixed income or on fixed incomes. So, we have problems on our hands. And all during this time, regardless of what the mainstream media tells you, it's been about protecting and enriching a 1% at the detriment for the rest of the country. So again, what are some of the other things that got here? They've been managing the economy based on perception, right? Everyone's telling you everything is fine, right? It's all about shaping your perception instead of having real results. And we here believe in tuning out the propaganda and focusing on the real world and what history tells us we should be investing in, not what they're trying to lead us into. So they've been more and more managing the economy centrally. And that is, if you follow the financial publications, every day's obsession is with the Federal Reserve. I mean, unfortunately, I'm old enough so that when I came out of college in the mid 80s, that when you used to read the Wall Street Journal, they actually talked about businesses. Now, the headlines are always just about interest rates and the Federal Reserve. The Federal Reserve tinkering with interest rates and the supply of money, that is centrally managing an economy. And that's where we've gone. And it never works when you put that power into the hands of a bunch of politicized bureaucrats. And that's where we're at. The true free market is shrinking, right? That's not a good thing. They're looking for more and greater controls on the economy to control things. And we saw that with COVID. They went beyond trying to contain a virus, but it was the economic impact by their response to it, whether you agree or not, was very detrimental to the economy. And it didn't seem to have a whole lot of thought for what the effects would be on the economy, especially the true free market. They've also been weaponizing the financial system. It's happening here, but you can see what's happening internationally. Just look at this war in the Ukraine, right? What's happening in the Ukraine between East and West is far beyond what the mainstream media is telling you. It is an economic war. It's about one system trying to break from the other. And we could go into that a little bit more later, but believe me, it is about the China's, the Russia's, India breaking away from the dollar-based system and the control the US had over the whole world. And what pushed these countries over the edge was systems that were supposed to be neutral, like the SWIFT system for transferring money, and holding dollars in reserve somewhere were not supposed to ever be weaponized, but that has happened. And that is not good for the average investor going forward unless you're properly protected. Unfortunately, one of their what will come out in the not too distant future is a digital dollar by the Federal Reserve to replace the US dollar. And that's not a good thing. We will not go into that here, but I'm sure you can figure that out, because once you go to a digital dollar, they literally control everything and have a view into everything you do, which again makes precious metals forms of money that would basically be the last form of money, because once they completely eliminate cash, your options are quite limited. You hear the talk about the new normal, and we're never going back to what we had, our systems we had before. So we need to prepare for the quote, quote, new normal. Now, based on the way the powers that be have been acting, what has the results been? Well, as I said, as forecasted by a handful of people outside the mainstream, including us here at Neptune Global, since our early years in the early 2000s, we said inflation would inevitably come about. You cannot just keep printing money without it happening. Of course, the mainstream media said that wouldn't be, but here we are, and it's uncontrollable, right? the Fed can only raise interest rates so much before they collapse a debt-based economy. And if they go back and they start lowering interest rates, well, they haven't even started to raise them. So it's still just talk. Basically, they're painted in a corner. So again, it's not reverting to normal. There's nothing they can do to fix it. If you just boil it down to like a family with unsustainable debt, that's where they're at. Even though they can print the debt or they can print the money, the world is rejecting it now. As I said, what you're seeing in the Ukraine is really a proxy for this war between financialized economies led by the US and London, right? Where everything is just financial instruments versus the commodity-based economies, real asset economies, and the economies that are producers. You know, the producer would be the China, right? They make most of the goods, right? Resource economies are like Russia and Brazil, the people that make the commodities. You know, those prices were trampled on for 2 decades as the financial economy rose. And people believe it will never change. Well, it had to change, and it's happening right now. And that's what this war is all about. It's an economic war, which is going to lead to probably a broader shooting war. What this has also done is, and it's not just from the pandemic, but the pandemic kicked it into high gear. But now with what you see going on with the sanctions and this economic war, which is what the sanctions are all about, is you're seeing the continued breakdown in the global supply chain. And you're now seeing shortages that have never been witnessed in any of our lifetimes on this phone. Unless you're a little older than me and maybe had times during rationing during World War I, you know, but post-World War II, post-World War II, you've never experienced shortages like we are now. Yes, a little bit of gas in the 70s, but now it's food, it's everything. And it's not likely to get better anytime soon. With the sanctions and the financialized weaponization that's happening out there, it is going to get exacerbated and get worse. Again, so invest accordingly. Invest knowing that the path we're on is not going to change. It's not going to reverse. It would be nice if it could. It just won't. Life moves on. So again, we need to prepare. And always remember, it's not a comforting thought, but the Federal Reserve and the economic planners are not your friends. They're not my friends, and they're not allies of ours. They don't really serve us regardless of what they may tell you. So preparing with new assets to preserve your wealth and preserve your purchasing power, which is what the ultimate goal during high inflationary times. It's best to start moving away from the assets that benefited from debt creation and money creation and move toward those that didn't. The ones that benefited for decades from debt creation and money printing will reprice. And that includes things like the stock market. The bond market, the existing bonds out there are going to get decimated because they have such low coupons. And as you know, bond prices move inversely to interest rates. So as inflation goes up and investors are going to demand more inflation, all those bonds out there with those very low coupon rates are going to be decimated. And that's on the books of the insurance companies, the pensions, you name it. Net, the dollar, the US dollar, as you probably know, is known as the reserve currency of the world. That is diminishing, right? It's not going to happen overnight, but it's in play. And what's happening right now with the Ukraine and the sanctions are speeding it up. So countries are looking for new arrangements, moving away from the dollar and valuing assets differently, devaluing financial assets and revaluing upwards of real assets that are tangible like commodities, which the precious metals fall under. Net, the fiat currencies, like the US dollar, are in a slow destructive mode. And you destroy them through inflating them away and them losing their purchasing power. Now, it shouldn't be a shock because all fiat currencies have a shelf life. They do not go on in perpetuity. People may believe they do, but the whole history of every fiat currency is that they eventually meet their demise. And the US dollar has been in the market about the same period of time as past fiat currencies. So the time has come, And the abuse of the printing has been unprecedented versus anyone in the past. So, it shouldn't be a shock. So the next thing is, when you're looking at assets and you're considering assets, is counterparty risk. Because of constant bailouts, right? Bailing out of the banks, bailing out of big investors, even bailing out of a lot of individuals, people have a feeling that there is no risk anymore. There will always be a bailout, but it comes a point where the bailout, where the money used for the bailout has less and less value. And that's what's coming now. So investors would be wise to start evaluating and appreciating risk and looking for assets with a better risk-adjusted return or a lower rate of or lower degree of counterparty risk. So how has the world been preparing? Okay, so for the last 2 decades, especially over the last 10 years, the central banks, and this is why when I say the world, I don't mean individual investors, I mean the people like the central banks of the different countries of the world and the sovereign wealth funds who really know what's happening, who really know the playbook, who know the motivations of their competitors. What have they been doing? Well, they've been buying gold, right? Just, no major central bank's been selling gold in the last 20 years, including the United States. But it's been buyers, and the countries that needed to get their levels higher, who were going to eventually take on and look to break from the US dollar-based global system, are the ones been acquiring the most gold. So that's been China and Russia and Turkey and India and Indonesia and countless others, okay? Other anecdotal things that have been happening because it's a sign that no one trusts each other. Historically, gold held by a lot of European countries were held in gold trading centers outside their country, predominantly New York at the Federal Reserve and London. Well, France just repatriated all their gold. So it was always held outside France, or most of it was held outside France since World War II. They don't trust even their allies, the United States. They took it back. Believe me, read into it because that's what it's telling you. Germany has only been able to repatriate half of their gold. The US will not release their other half. They don't give a reason, but that's not a good sign. A little bit similar to when they just kept the reserve assets of Russia under the guise of punishment for the Ukraine situation. Venezuela repatriated their gold years ago. So the point is, everyone's trying to pull their assets, their true assets, back home. No one trusts anyone. Okay, so trade between nations is moving and trying to move away from the dollar. If you know that since the sanctions came, Russia is now trading and selling energy to China, not using US dollars anymore, right? The petrodollar, you may be familiar with that saying, used to be behind every trade. People would buy energy using US dollars, but people are now moving away from that. And this is a big deal because that's what propped up the dollar and kept it as the world reserve currency. India is now looking to buy energy and products from Russia and commodities from Russia using their local currencies, the rupee and the ruble. Saudi Arabia, who was the cornerstone of the petrodollar system, is now looking at selling their oil to China for yuan. So again, it's not happening overnight, but things are in play and it's not turning back. Right? Everyone showed their hand. Financial systems, the dollar, the SWIFT messaging system has been weaponized when they weren't supposed to based on their charters. And now it's no going back. So we are in the process of transforming from what they call a unipolar world where the US controlled everything, especially through being the world's reserve currency and the large military, to this battle where it's moving toward a multipolar world where there'll be other spheres of power who will now start doing trades and transactions outside of the systems of the West. But the reason we're presenting this information is because it's probably best to think and act like the other world powers, because what's being done and the path we're on is not going to change, and the powers that be aren't here to really serve you, right? So we need to, in my opinion, and I've done it, and our clients have been doing it, and it served them well, even before we got to this very obvious stage where we go to the next leg of this great reset, as the term is used by many people. Okay, so now let's get to the specifics of investments. So why are precious metals so unique in a time like this? So they're liquid, they're extremely liquid, right? You can buy and sell them in real time. We do it all day long as a precious metals dealer and predominantly as a market making precious metals dealer. That's different than corner coin shops or people that are really dealing out of their pocket. Precious metals are portable. You can move them around, right? So when people may say, well, real estate is a hard asset and it's real, and we'll go into some of the differences on that later, but it's not portable. So, if you're in New York City right now, and ever since the changes since the pandemic, that asset you can't take, you are stuck there. It's a local asset and you've got local government overseeing it and taxing it. And they'll probably raise their taxes as the local government continues to destroy their local economy, because that's what governments do. Precious metals are also divisible. You can buy $100,000 in gold and piece it off a couple $1,000s at a clip, which makes that a very attractive asset. Or if you feel a metal, you want to hold on to your asset, but you need to raise some cash, or it's starting to hit some price targets you have, but you don't want to take your investment completely off the table, you can slowly take your asset, cash out your asset. Gold and precious metals have been accepted for 5,000 years as money, and it's not changing. As I said, the world is repatriating their gold. They've been acquiring more gold. Russia loosely linked the ruble to gold a week ago, right? So it's not changing, regardless of what the mainstream media, and I hate to say it, clowns like Jim Cramer, right, who are just always selling meme stocks, keep telling people. No, it is money, it has been, and it will continue to be. And gold and precious metals in physical form, not as an ETF, not in a mutual fund, because they're loaded with counterparty risk, but when you actually own the physical metal, it has no counterparty risk. And that's unique. And we'll just talk about that in a little bit more, because as I said before, as you see things breaking down, risk needs to now be evaluated and managed more than ever. So is there counterparty risk in other competing assets? Well, let's take a look. Stocks, ETFs, equity mutual funds, absolutely. Because first of all, what is a stock? A stock is an operating company. The risk is that the people who are running that company are incompetent, or that they may be even in a good industry, but they don't run the company well, or they're personally corrupt and they're really serving themselves more than the stockholder or the investor. So therefore they damage the company by either their actions voluntarily or involuntarily. So that's counterparty risk. Bonds have counterparty risk. It's real simple. Bond is lending money. If the person it's lent to doesn't pay you back, like a note, that's risk, right? It loses its value, it loses its marketability. Or if the interest rate is too low and the rates go up, the bond gets crushed. But your biggest risk is that the debtor or the borrower will not pay back. Real estate and REITs. Real estate has counterparty risk, especially if it's income property, right? Because your tenant may not be able to pay, or the local government raises the taxes because they need money, and that's not easy to pass on. So those are real counterparty risks. Now, it doesn't mean the income stream from something like real estate isn't valuable to investors, but there is a risk that goes with it, and that should be always evaluated. Mining shares, people will say, well, I'll invest in precious metals, I'll buy mining shares. Mining shares aren't precious metals, they're companies that dig for precious metals, they're operating companies, and they have all the associated risks that any operating company has, even some more. When countries get in deep trouble, they nationalize mines. And so if you own those shares, that becomes a problem. That happened in Venezuela about 10 years ago. They nationalized private mining companies, and that obviously just wiped out the shareholders. Gold ETFs and other derivatives. As I said before, precious metals are ideal for this time. They've been good for 20 years, but it's really coming into their own. But if you go for something that Wall Street creates, like an ETF or other derivative, you're taking on counterparty risk that makes no sense. There are so few investments that you can truly own directly. to give that up and go into something that Wall Street creates for their convenience, I think you're doing yourself a disservice. Physical precious metals, as we said, when the physical metal is there that you own, that is the only form without counterparty risk. So I talked about managing perspective. Just to put something into, to make things clear about an example of the mainstream financial media. If you were to ask the typical broker dealer, wealth manager, where's the best place to be for the last 2 decades, right? I don't think we'll all agree 2 decades is quite a track record. The answer would always be the stock market. Now, if you said you invested in gold, they would think you're crazy. They would say, well, gold is volatile, it's this and that. So just to be clear, 20 years ago, if you put your money into gold or the Dow, and it's basically the same for the S&P 500, gold is up over 500%. The Dow and the S&P are up a little over 200%. That is beyond a material difference. You would never hear that from the mainstream media. It's a fact. You could just look up the data, look up the price of gold 20 years ago versus today, and what the Dow or the S&P were selling for 20 years ago versus today. Do things move up and down during that period of time? Absolutely. But the bottom line is gold has seriously outperformed the stock market. And you would never hear that from the mainstream financial people. And I bring that up because that's why, in my personal opinion, you need to tune those folks out. So just so you know where we're coming from, and we're going to go back and what we shared with investors in the past to show that I believe we have and again, this is our opinion, a pretty good handle on things. If anyone here has listened to one of my webinars some years ago, they will know that I talked about that. And this is why I launched the company in 2002. It wasn't by accident, that we were going into a long-term secular bull market. And secular markets can run 20, 25 years plus. And I said there's 3 legs to a bull market. The first leg up, the second leg is a 50% retracement of the gains made in the first leg. And then the third leg is the biggest move. Will far outdo the leg 1 if we follow the script of a classic bull market, which I've always felt we have. And as each week and day and year passes, I'm more and more sure of it. So in 2015, which was 7 years ago, on a camera webinar, I put up this graph. And I said, again, 3 legs of a bull market. And that ran, and it peaked gold in 2011, 12. And then it was in the second leg at the time. Now it hadn't hit the bottom. And as I said, and this chart, as you see the green line that says the 50% retracement, I said it's likely to continue to go down for a short bit before gold starts on its third leg. So that was in the future. And even the bottoming of leg 2 was in the near future. Again, that's June of 2015, as you see in that red box. Okay, was published in 2020. Now let's look back. The retracement was that, or the bottom of leg 2 was hit, and it hit exactly 50%. So it's been a textbook bull market or secular bull market. And it had started its third leg as was predicted in 2015, not because of a crystal ball, but just understanding markets and seeing that everything was coming together where gold was going into a classic textbook market and investors could benefit from it. And it took off. So in June 2020, at the time, at the end point, at that point of leg 3, it was at $1,550 an ounce. Now, as I said before, that third leg is the biggest gains are in that third leg. And as I said in 2020, that it still has a long way to go, that, hold on, because this is what the investors really are in the metals for. So one of the takeaways from this, I hope, is that you see, regardless that maybe some of you or none of you enjoyed what happened in leg 1, there's appears to be, and there should be, according to our calculations. And what we've been tracking for years, which has played out exactly, is that we're in leg 3, and leg 3 is the biggest gains. So again, 2 years ago, it was at $15.50 an ounce. Some people panicked, right? If you look at right at the end, you see gold had dropped a little, but our position was don't panic. You can't be looking at things on a weekly or monthly or even quarterly basis. This is an asset that you're holding for the intermediate to longer term. This is about wealth preservation. So now let's jump to 2000 and here's that chart again, but see that gold star? That's where gold is right now as we're having this webinar. $1,953 an ounce, may be a little different because that was updated a couple hours ago. So as you can see, in June of 2020, when gold was at $1,550, I had said, no, we're in leg 3. We are in the upward trajectory. Don't worry about any short-term ups or downs. I think you would all agree a $400 move in 2 years is pretty good. So $400 on 1,550, you're talking about a 25% move, basically a little bit more. That's pretty good. And I still stand by gold's best days are still in front of it, because what we have transpiring now with the inflation and the economic wars and the battles between East and West and the commodity based economies versus the financialized economies, that is fuel for the gold price. That is far more powerful than what we had in the past. And just one other, anyone here is a chartist. I just like to use charts also to validate fundamental analysis. And for those of you who may know about what they call the cup and handle pattern, it's considered the most bullish pattern for an assets trading. And as you can see with that gold, I'm sure you can figure out the cup and the handle. That is, gold is in a classic cup and handle, which just again confirms, because that handle, once it breaches the far right handle, it just takes off. And as you can see, again, 1953 is the current price of gold. That is above, it's right exactly where the handle would say it should be. So I'm quite excited. I can tell you we've been doing tremendous amount of business, especially as investors are so cognizant now of inflation. They see their money in the bank. Now they know it's going to be decimated. If you have $100,000, $200,000 in the bank, and we have real inflation of 15%, you're going to lose $15,000 in purchasing power for every $100,000 by the end of the year, if not more. People will ask, what about silver? Silver lags gold. It's more volatile, but it's also following the 3 legs of a classic bull market. And people will ask, gold versus silver. We'd be happy to chat with people about that. Now, we've made one thing even better. Will mentioned in the beginning, we have a patent. We created the PMC ounce, which is the precious metals composite. That is, for each PMC ounce bought, there is a fixed amount of physical gold, silver, platinum, palladium that you will own. That diversified position was designed to give a better risk-adjusted return, which means not necessarily total return. It's a better, smoother ride with less volatility, but it's also been delivering not just that since its inception in 2008. It went to market basically in 2009. So it's got a great track record, long track record, but it's outperformed also on a total return, gold or silver. So as of this morning, since its inception, the PMC ounce was up 183%, silver 144%, and gold 131%. So it's just an easy way to say, we believe diversification in the metals makes sense. We made a nice turnkey, efficient way of doing that. And it is designed to seek a better risk-adjusted return. And you can see this chart every day. It's updated live. It's on our website, neptuneglobal.com. So a couple things I'll just share because I'll wrap it up. And if you have questions, you can put it in the question box. I know some people ask about cryptocurrencies. We've got our opinion on that. If you go to our website, we have a download you can get, Why Crypto or Gold in 2022. It really looks at a lot of aspects of cryptocurrency and gold that maybe we didn't cover here, especially we didn't cover anything with crypto, but also people that you follow in the market who may shy away from, especially regarding crypto, because maybe it doesn't support their position. It's what we believe, a very balanced, logical way of looking at these two assets. And basically one thing, Bitcoin is not the new gold, but it doesn't mean there isn't a place for Bitcoin. But it addresses what Bitcoin and cryptocurrency really is versus what people thought or wished it was going to be, and how it's really proving itself to be. So again, you could go to our website to download that. Also, we deal in all the traditional bars and coins, but our most innovative products and ones that investors gravitate to the most, especially in IRAs, are the gold and silver vault account, or the PMC ounce. If you go to our website, we have fact sheets. Good place to start. You can download and right from the website and take a look at them. Also, if you like to follow the precious metals and even the major cryptocurrencies, we have a free mobile app. It's great. It's got it does have even the spot price for the PMC index, which is the spot price for the PMC ounce, plus of course, gold, silver, platinum, palladium. If you look at the graphic, it says cryptos also. You'll go there and see the top cryptos like Bitcoin, Ethereum, and Litecoin. And again, that's a free app. That you would just go to our website also and scroll down on the home page, and you can see where the links are to the Google Store or the Google Play and the Apple Store. And lastly, if you have any questions, we encourage you to either call us, and if you'd rather not call, you just go to the contact us and submit a question. I'll be happy to answer any questions on this call now. I believe we have a Q&A functionality with this on this webinar, so I'll address that. Just lastly, like to say the PMC ounce, if any of you have followed the analyst Jim Rickards, he discovered it. He didn't discover it, he discovered us, because of the PMC ounce going way back at like 2011 or 12, and has in print recommended it in his newsletter multiple times, his newsletter Strategic Intelligence, and he described it as the most intelligent innovation in precious metals investing ever devised. So that was quite a compliment from an individual that's considered to be quite knowledgeable on gold, the world financial system, money, we've been very appreciative of that. So with that said, if anyone has any questions, I don't know how Will works. I do see one question about, will the recording be sent out? That we'll let Will answer. So any questions?
Thank you, Chris. So this webinar is being recorded. If anybody would like a copy of the recording, just feel free to email info@camaplan.com requesting such, and we'll go ahead and send out the recording once it's compiled.
Okay, if that's it, I'd encourage everyone to visit our website, neptuneglobal.com. It's got a lot of material there that I think you'll find very helpful to learn more about us. And again, you can get the crypto gold report. You can get the fact sheets on the products like the PMC ounce. And and we deal in all the traditional bars and coins, both inside and outside IRAs. And we've been working with Camaplan for over 15 years. So we have a long track record and we have a good working relationship with them. So we're really in a good position to support precious metals investing in an IRA for Cama's clients. So Will, thanks a lot for putting this together.
Thank you, Chris, for the very informative presentation as always. And thank you everybody who have attended. As Chris said, feel free to reach out to Neptune Global with any questions about PMC ounce or precious metals. And if you have any questions about how any of this applies to self-directed IRA, our phones are always open. You'll talk to a live person, and you can reach us at info@camaplan.com. Thank you, everybody, and I hope you have a great rest of your day.